Most people think taxes are a bill. That is the first mistake. Taxes are not just a bill. Taxes are a map, they are a reward system, they are a pressure system, they are a behavioral machine built by government to pull private capital toward whatever Washington wants. Built badly enough jobs, housing, energy, factories, equipment, expansion risk taken by somebody else. If you do not understand that, you will spend your whole life standing on the wrong side of the table, wondering why one person sends half his effort to the government while another person seems to grow richer at the exact moment he is writing off the cost of getting richer. I have spent my life watching people obsess over the stock they should buy and the market they should time, while ignoring the most important investment return many of them will ever earn. The return that comes from reducing the amount of capital that leaks out of their life every year. They hunt for a 10% return in the market while tolerating a tax structure in their own household that quietly destroys 20, 30, 40% of every additional dollar they earn. That is not intelligent investing. That is financial self-sabotage dressed up as normal adulthood. The richest people are not playing a different game because they are smarter in some mystical way. They are playing a different game because they stopped behaving like income collectors and started behaving like capital allocators. They stopped asking, how do I earn more? And started asking, what does the tax code want me to fund? Once you ask the second question, the whole picture changes. The average worker lives in what I call the extraction lane. Money comes in, the tax system takes its bite early. Payroll taxes, federal taxes, state taxes. Then the bills arrive. Mortgage, groceries, insurance, car payment, school costs, repairs. Whatever remains gets invested late, timidly. Usually after most of the compounding power has already been bled out of it. The allocator lives in a different lane. He earns, yes, but more importantly, he directs. He routes cash toward activities the system is designed to subsidize. He understands a brutal truth that most people resist because it sounds unfair. The tax code does not love effort equally. It rewards certain forms of behavior much more aggressively than it rewards labor alone. If you only sell your time, you are usually taxed before you can reposition the money. If you build, acquire, improve, or produce the things the government wants more of, the code often lets you deduct, defer, depreciate, or credit your way into a much lower tax burden. That is not cheating. That is the operating system. And if you do not learn the operating system, you will keep interpreting the outcomes as luck. When I read a tax code incentive, I do not read it as a technical paragraph. I read it as a confession. Government is telling you, plainly, we need this done, and we cannot do it ourselves efficiently, so we will pay private actors to do it through the back door of the tax return. That is the mother line. The IRS is not handing out money because it likes you. It is handing out incentives because the country needs productive behavior, and the tax return is one of the cheapest ways to purchase it. The code is a giant menu of bribes for people who are willing to take real-world action. Once you see that, 3 doors open. The first door is business. The second door is real estate. The third door is energy and other politically important production. Most people never walk through any of them. They stand outside, collecting W-2 income, then complain that the wealthy have special rules. The wealthy do have special rules, but those rules exist for a reason. They exist because the government wants businesses created, buildings maintained, and energy produced. The tax code is not a morality play, it is an incentive architecture. So let me diagnose this clearly. If all you do is earn and consume, you are behaving like raw material. If you build systems, own productive assets, and solve government prioritized problems, you are treated more like a partner. That identity flip is where intelligent tax planning begins. I want you to understand the first mechanism because it is the most important one and the most misunderstood. I call it the gross to net trap. Employees are usually taxed on gross income before they have much control over how capital gets deployed. Business owners generally pay tax on net income after ordinary and necessary business expenses. That difference sounds technical until you live with it for 10 or 20 years. Then it becomes one of the biggest wealth gaps in society. Imagine 2 people each produce the same amount of economic value. One is paid as an employee. Much of the tax bite shows up before that money can be repositioned. The other earns through a legitimate operating business. That second person may be able to deduct software advertising, contractors, certain travel tied to business purpose, equipment, professional fees, part of communications infrastructure, and other costs of operating the enterprise before arriving at taxable profit. In many cases, there are additional provisions layered on top. including startup cost deductions for new ventures, and, for eligible taxpayers, a qualified business income deduction that can reduce taxable business income further. Now stop and think about what that means. One person is carrying life on after tax dollars. The other is building life through a structure that may transform part of the same economic activity into pre-tax deployment. That is not a small advantage. That is a compounding advantage. This is why I get impatient when people say, I just want to keep things simple. Simple compared to what? If your version of simple means volunteering for the most exposed position in the tax system for 40 years, that is not simple. That is expensive. You do not need a giant corporation to begin thinking like an allocator. The source document rightly points out that the code allows deductions for legitimate startup and organizational costs, and that small businesses can unlock broader deduction logic the average employee never touches. The principle matters more than the glamour. The business can begin as a side venture, a service, a niche operation, a small agency, a local trade, digital consulting, specialized design, a distribution activity, a tiny operating company. The point is not to cosplay as an entrepreneur. The point is to move from pure extraction into productive structure. The moment you do that, the tax return starts reading your life differently. Now let us push deeper, because a lot of people hear this and immediately corrupt it in their head. They think tax strategy means inventing fake expenses, pretending personal indulgence is business activity, or copying snippets from social media. That is how amateurs get burned. That is how fools turn a good system into a bad personal outcome. The real game is not fraud. The real game is alignment. The code rewards risk, investment organization, payroll creation, equipment purchases, and operational spending tied to actual enterprise. It rewards people who put capital in motion where the country wants more motion. That is a completely different mindset from trying to hide. I call this the builder premium. The builder premium is simple. If you build a thing the country needs, the tax code frequently helps fund the build-out, sometimes through immediate expensing, sometimes through depreciation, sometimes through credits, sometimes through preferential deductions, sometimes through deferral. But the pattern is consistent. The code is constantly saying, if you are willing to do the work of productive expansion, we will lower the after-tax cost. That is why large businesses so often look as though they are taxed on a different planet. In a sense they are, not because the math is magical, but because the activities they undertake are exactly the activities the system is hungry to encourage: warehouses, machinery, research, development, hiring, infrastructure, logistics, expansion. These are not just expenses in the eyes of the code, they are nation-building behavior. The average person hears that and gets angry. The investor hears it and asks a better question: how much of my future can I move from consumption into encouraged production? That question leads to the second mechanism. Real estate. Real estate is one of the great mirrors in finance because it reveals whether you understand the difference between cash reality and tax reality. In cash reality, a well-bought property may appreciate over time and produce rental income along the way. In tax reality, that same asset can throw off deductions that make the taxable income look far smaller than the actual economic benefit. This is where many people get their first glimpse that the system is built for owners. The source document makes the key point. The IRS generally allows depreciation deductions on rental property and related improvements over prescribed lives. Even though real estate in many markets can rise in value over time, that is a profound asymmetry. You own an asset that may strengthen economically, and the code may still permit you to recover basis through depreciation deductions. On top of that come the ordinary expenses of operating the property: mortgage interest where applicable, taxes, insurance, repairs, management, and other eligible costs. So the amateur sees a landlord collecting rent. The informed investor sees a stack of cash flows, equity creation, leverage, depreciation, and tax positioning all operating at once. That is why mediocre real estate can still create respectable wealth and excellent real estate can create extraordinary wealth. But I want to be careful here because this is exactly where people become intoxicated by surface-level tax talk. Real estate is not a magic wand. You can overpay, you can buy in a weak area, you can underestimate maintenance, you can use bad debt, you can get trapped in poor property management, you can misunderstand passive activity rules, and discover that a theoretical deduction is not as immediately usable as some online salesman promised you. All of that is true, but none of it changes the core diagnosis. The code wants housing and productive real property maintained and expanded, so it makes ownership more attractive than the average person realizes. Then the strategy becomes sharper. A cost segregation study, when appropriate and properly executed, can pull portions of a property into shorter recovery periods and accelerate deductions. Since bonus depreciation was restored for certain qualified property acquired after the 19th of January 2025, the front-loading potential became more powerful again for eligible assets and facts. In plain English, the tax code may allow you to recognize a meaningful chunk of deductions earlier rather than later when the circumstances fit. That timing difference matters enormously because an early deduction is a stronger weapon than a late one. Time is not neutral in investing. A deduction this year is not the same as a deduction 7 years from now. One gives you capital to redeploy immediately. The other gives you a memory. I call this the timing weapon. Sophisticated investors understand that a tax benefit is not merely about the amount. It is about when the amount arrives. Money kept today can buy an asset, reduce debt, fund expansion, or survive a recession. Money saved years from now has weaker optionality. So when a strategy legally accelerates deductions, it is not just changing the tax bill, it is changing the speed of compounding. That is why front-loaded depreciation gets so much attention. That is why deferral strategies matter. That is why a properly handled like-kind exchange can be so powerful in the right context. Section 1031 does not erase gain forever by magic. It generally allows qualifying investors to defer recognition of gain when they exchange eligible investment or business real property for other like-kind real property under the rules. Deferral is not a headline trick. Deferral is retained capital. Retained capital is fuel. Fuel changes trajectories. If you still think this is just about tax paperwork, you are missing the whole picture. This is capital velocity. The third door is the one that excites people the fastest and punishes them the hardest if they approach it carelessly. Energy, the source document, frames it the right way at a high level. The government needs domestic energy production. Energy scarcity flows into transportation, manufacturing, household budgets, and inflation. When something sits that close to the spine of the economy, incentives follow, and they do. The tax law contains specialized rules for certain oil and gas activities, including the ability in some circumstances to currently deduct intangible drilling and development costs, and for qualifying taxpayers and properties to benefit from depletion rules. Those provisions can make certain energy investments unusually tax-advantaged compared with ordinary investments. But let me say the part that gets buried by aggressive promoters. A tax advantage does not turn a bad deal into a good deal. A deduction is not a business model. A K, one with a large paper loss, is not proof of economic intelligence. This corner of the world can be real, specialized, illiquid, operationally risky, and in many cases suitable only for investors who both qualify and understand what they are buying. If you enter it as a tourist because someone sold you the phrase "the IRS will pay you," you are behaving like prey. The right way to understand this category is not as easy money. It is as a reminder that the code becomes very generous when the state wants more of something badly enough. That is the underlying law of the whole system: jobs, housing, energy, production, scale. Not all dollars are taxed the same because not all behavior is valued the same. Now, I want to bring these three doors together, because this is where people either mature or stay financially adolescent forever. Most households operate with an earn and report protocol: earn, withhold, file. Hope for a refund, repeat. That protocol can keep you compliant, but it rarely makes you powerful. Wealthier operators use a different protocol: assess what the code is trying to buy. Position capital where your competence overlaps with that demand. Use legitimate entities and records. Invest into productive assets. Capture deductions, credits, depreciation, or deferrals where the law allows. Retain more capital. Redeploy retained capital. Repeat. That is an entirely different blueprint. I call it the incentive capture blueprint. And before somebody accuses me of making this sound too easy, let me add the missing honesty. This blueprint is not easy. It requires judgment. It requires restraint. It requires accounting discipline. It requires understanding the boundary between aggressive planning and stupid planning. It requires substance, and it requires one virtue that almost nobody wants to hear about anymore: patience. Because the real edge is not the one-time write-off. The real edge is becoming the kind of person whose whole financial life keeps moving through channels the code naturally favors. That takes years. This is why I say tax planning is not an annual event. It is a life design problem. If you make all your economic decisions first and ask tax questions later, you are usually too late. You are treating the return like a scorecard. Intelligent operators treat it like a dashboard. They make structural decisions before the year is over, sometimes before the deal is signed, sometimes before the entity is formed. The tax consequence is not an afterthought. It is part of the design. That single shift separates dabblers from architects. Let me make this even more blunt. If your life is organized entirely around wages and consumer purchases, the code is mostly going to process you. If your life is increasingly organized around building, owning, and allocating, the code may start partnering with you. Again, not because the universe is fair, because the state is trying to engineer outcomes. That is why I laugh a little when somebody says, "I do not want to start a business because it sounds risky," while they quietly accept a lifetime of concentrated dependency on one employer, one paycheck, and one tax treatment. That is also risk. It is just familiar risk, which most people mistakenly call safe. The employee with no side activity, no productive asset base, no control over deductions, and no strategic flexibility is not standing in safety. He is standing in rigidity. And rigidity becomes fragility. The moment the economy changes, the job disappears, the industry contracts, or the inflation rate makes old assumptions obsolete. A small business does not guarantee wealth. A rental property does not guarantee wealth. An energy investment certainly does not guarantee wealth. But each of them sits inside a zone where the code is more willing to reduce the effective cost of action. That matters. Now let me give you the practical operating system in plain language. First, stop asking which deduction is trending online and start asking which form of productive ownership actually fits your temperament and competence. If you are disciplined, client-oriented, and operationally dependable, a small service business may be your door. If you understand local markets, financing, maintenance realities, and tenant economics, real estate may be your door. If you are already sophisticated, well-advised, risk-aware, and able to tolerate complexity and illiquidity, certain energy deals may be a narrow door worth studying carefully. But the sequence matters. Competence first, structure second, tax benefit third. Anyone who puts the sequence in reverse usually gets injured. Second, document reality like a professional. The tax code rewards substance, not storytelling, separate accounts, good books, clear purpose, real contracts, real invoices, real minutes, real mileage records, where required real distinctions between personal and business use. People talk about tax planning as if it were built from clever phrases. It is built from evidence. Third, understand the difference between deduction, deferral, and destruction. A deduction can reduce current taxable income. A deferral can postpone tax and keep capital in motion. Destruction happens when someone buys a terrible asset for the privilege of getting a tax break. Never confuse tax reduction with wealth creation. The tax tail must not wag the economic dog. Fourth, respect leverage, but never worship it. Debt can amplify real estate. Debt can help businesses scale. Debt can also turn a promising plan into a forced liquidation when the cycle turns or the rate resets. I have seen many more people hurt by optimistic leverage than helped by it. If a strategy only works under perfect conditions, it is not a strategy. It is a fantasy. Fifth, remember that permanence is more valuable than intensity. A person who keeps one legitimate business for 15 years, reinvests intelligently, captures ordinary deductions, possibly benefits from qualified business income treatment, where eligible, and steadily redeploys capital may build more enduring wealth than the person chasing exotic tax shelters every spring. The great fortunes are usually not built from excitement. They are built from durable structure. That is the final mechanism, and perhaps the most important one of all. I call it the self-funding flywheel. Here is how it works. You build or buy an asset the code favors. That asset throws off cash flow, deductions, or both. Because you keep more capital after taxes, you have more money to reinvest. Because you reinvest, you can buy more productive capacity. Because you own more productive capacity, you generate more options. Because you have more options, your dependence on any single source of earned income falls. Because your dependence falls, you can make calmer decisions. Because you make calmer decisions, you allocate better. And because you allocate better, the flywheel accelerates. This is what people mean when they say wealth feels easier after a certain point. They are not saying the world became fair. They are saying the system started pushing in the same direction as their behavior. Now, there is one more psychological trap I want to rip apart before I finish. Many people secretly believe they will begin serious tax planning once they make more money. That is backward. The habits you build at smaller scale determine whether larger scale will help you or expose you. If you cannot keep records on a modest side business, larger revenues will not rescue you. If you buy sloppy assets now, more cash later will only let you buy bigger sloppy assets if you do not understand the difference between a real investment and a deduction-shaped vanity purchase. Higher income will simply make the mistakes more expensive. You do not wait to become disciplined. Discipline is how you become the kind of person who can handle scale. And that brings me to the moral error most people make when they hear this discussion. They hear business ownership, real estate, depreciation, energy incentives, and they immediately decide the conversation is only for rich people. Number this conversation is how many people become less small. A side business can start small. A first rental can start small. The study of the code can start with 1 hour a week. The habit of thinking like an allocator can begin before the income changes. The key is not pretending you are already a tycoon. The key is refusing to remain a pure wage recipient forever if you have the ability to build something else. That is the threshold. And here is the uncomfortable mirror I want to leave you with. Every April, millions of people sit down and ask what the government took from them. Far fewer ask what the government would have paid them to do. That second question is the adult question. It is the investor question. It is the builder question. It is the question that separates the person who is processed by the system from the person who learns to navigate it. So make a contract with your future self. Do not promise that you will chase every tax gimmick. Do not promise that you will become reckless in the name of deductions. Do not promise that you will buy assets you do not understand just because the brochure says tax advantaged. Promise something more serious. Promise that from this point forward you will stop living as if taxes are merely punishment. Promise that you will study the incentive map. Promise that you will direct at least part of your capital toward productive ownership. Promise that you will build legitimate structure before you demand extraordinary outcomes. Promise that you will not confuse income with wealth. Promise that you will stop admiring sophisticated allocators from a distance and begin, in a scale appropriate to your life, behaving like one. Because the real divide in this country is not only between high income and low income, it is between people who understand that the code is trying to buy behavior and people who spend their whole lives selling labor into a system they never bothered to read. One group keeps asking for relief. The other group quietly positions itself where relief is already written. That is the game. That is the diagnosis. And if you do not understand that, you may work hard for decades and still never understand why the people building businesses, owning property, and funding politically desired production seem to move ahead while you remain stuck negotiating with whatever is left after withholding. The IRS is not generous. It is strategic. Your job is to become strategic too.